Alright, what's up guys? I'm going to try to explain to you what standard deviation is and how you can use it and how it can help you improve in your trading. So basically the way standard deviation or what standard deviation is, it's pretty much where you could expect price to be drawn to, where it can consolidate, where it can retrace, where it can reverse, or where it can give you another target for your trades. The way it works, standard deviation, you guys probably heard it in math. It's pretty much the likelihood of blah 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 hitting something, I'm pretty sure, or it's some type of target, geometry, whatever the case may be. So the way that you would implement it in your trading is it's going to be able to know where you think the market's going to go, where you can have your take profits, where do you expect price to retrace into to have your um, entries and whatever the case may be. The best way to use it is pairing it with your power of three. The way you would use it for your power of three is that you pull it from your manipulation leg. You can also pull it from the first distribution leg. I know some people use it, some people don't. If you just want to pull it strictly off your manipulation leg, that's what you should do. If you like it, that's up to you. So the way it would work, right here in this example, let's say you have your accumulation, and the way that you know you're getting manipulated is when you get your stop hunt or your liquidity grab. So right here, let's say we have equal lows here. Price ends up taking this low, which would be, taking out the sell side, which would be your total soup, which will also be your dealing range, right? Since we souped it, your recent swing high, the swing low that got souped, pull it from here. What you expect price to do is go straight to your 2 to 2.5. At your 2 to 2.5, you could expect it to go to 1.5 to 1, which would be your silver bullet zone. It could also go all the way to 0, and this could be like your whole re-entry point, your reconsolidation point, waiting for your internal model to play out, which is a lot of people do. So let's say price goes all the way to 2 to 2.5. You're going to expect it to stay around 1 to 1.5, reconsolidate, giving your second entry your internal model with another soup, and you would expect price to go to your 3.5 to 4, or some people like to use 4 to 4.5. I personally like to use 3.5 to 4 because usually when I try to use standard deviation, I don't really see it playing out past 4 or all the way to 4.5. So this is just personal preference on my part. And then, which would be your market maker switch, or would you expect a higher time frame market structure shift to happen? So you have your soup at the lows, pull your standard deviation off your manipulation leg, hit your retracement to reversal, then it's going to retrace to your silver bullet zone, reconsolidate, giving your second entry, and then push all the way to 3.5 to 4, and then you're going to expect a reversal at that point. Another example that can happen is just a simple AMD or power 3 as well. You have your accumulation. We sweep the low, making a new dealing range, pulling your manipulation, your standard deviation off your manipulation leg. It's 2 to 2.5, and it just reverses. No retracements, no nothing, just a straight dump. Another thing that can happen is we totally disregard our silver bullet zone or our reconsolidation, whatever the case may be. Another example right here, or same example, sweep the low, manipulation leg. That's where you pull your standard deviation. We can hit 2 to 2.5. We could also consolidate here, giving you your second entry, or it could just straight bypass 2 to 2.5 and hit your 4 and then have the reversal. So you would want to enter off the manipulation leg or your first distribution leg. Let's say we have our market structure shift here. We dip down to our FEG like a 2022 model, giving you your entry here. Around 2 to 2.5 and 1 to 1.5, you could have your internal models, wait for the internal sweep of liquidity, and hopefully have some internal SMT at the lows, and that will help you out. I have a few examples that I can show you guys as well. This first example is on a higher time frame. This is going to be in the 1 hour. I know you said we have to wait for our soup, but on ES we did end up taking this low. On NQ we didn't, so that's a soup on ES, but the standard deviation played out more on NQ, so I'm just going to use it here. So we had SMT at these lows, giving it a turtle soup. This will be the candle that sweeps it. You're going to pull your standard deviation from here, from this low to the most recent swing high. Right here, we jump all the way to 2 to 2.5 right here, giving our retrace to the silver bullet zone. Right here, it was just another FEG tap, giving you your second entry, and then we tap 2, go back to 1.5 to the tick, filling in this 1 hour FEG. That will be your second entry. We push all the way to forward 4.5, which is something I don't really like to look at. And then boom, we just have a reversal, right? So that's one example. 2 to 2.5, retrace the silver bullet zone, giving you your second entry, pushing all the way to forward, giving you your final take profit, and having your market maker model switch since we're in a buy model, and then we proceed to a sell model. Another example I have right here is one. We have our manipulation leg sweeping this low. This is our most recent swing high. The low that got swept, which would be your turtle soup, your new dealing range. That's going to be your manipulation as well. We sweep this low. We tap into OTE of this range, tap into this 5-minute FEG, pull the manipulation leg, your standard deviation, and then we have our 1 hour FEG, which would be your DOL, your drawn liquidity, and 2 to 2.5. Tap the 2 to 2.5, and then we would just retrace. We could somehow see a little bit of a consolidation point right here at the 1.5, which would also happen. It could also all the way go down to 0 to 1. This will be like your negative 1.5 to 0 will be like your second entry point. If it does dip around to 0, it's a little bit less probable depending on the market structure. But once you guys have experience on using it, you would know exactly what to look for. I have one more example for you guys right here. We sweep this high. This will be your new dealing range. You're going to pull it from the most recent swing high to your swing low. Some people like to use it from wick to wick, wick to wick, and I know some people like to use it to wick to body. So this was an example that I found for you guys as well. Sweeping this high, turtle soup, your accumulation, manipulation, sweeping these highs, tapping into our FEGs at the highs, order blocks as well. And then you're going to pull your manipulation leg. Right here you can see we tap 2 to 2.5, retrace to the silver bullet zone. We also go a little higher, which is okay because if you're following market structure, this could have been a unicorn setup on the 3 to 5 minute FEG tap as well, giving you a better entry because it does go into OT, I'm pretty sure. Yeah, 0.62, everything like that. And then goes all the way to 4 to 4.5, and then it gives you that little market maker model switch, and then it does end up dropping a little more, but that's okay. You are expecting a reversal at this point, and that's what you got. Accumulation, manipulation, pull your standard deviation, tap 2 to 2.5, retrace to your silver bullet zone and a little higher, giving you a better entry on your shorts. And then we tap 4 to 4.5, and then we have a reversal. So that's pretty much how to use standard deviation. You're going to pair it with power of 3. You're going to get your targets 2 to 2.5, 4 and 4.5. You're going to give your retracement / re-entry points between 1 to 1.5. And it could go to 0, but it's not as probable. So once you guys use it, you guys will be able to, like I said, you guys will be able to know what you want to look for, what are more high probability than whatever, and whatever goes with your model. And that's pretty much how you use it as well.